The stock market has a gift-giving season, and it happens actually more often than you would think. The Santa Claus rally is a real pattern where stocks tend to rise in the last 5 days of December and in the first 2 days of January. Since 1950, these 7 days have actually produced positive returns roughly 78% of the time, with an average gain of 1.3%. So what drives this seasonal bump? First off, investor psychology plays a pretty big role. Holiday optimism and positive sentiment really just lead people to buy. Second, institutional investors, they take off for the holidays. So these lower volumes in the market make price swings a little easier. Third, tax loss selling tends to have subsided by this time. This means less downward pressure from people selling losing positions. Finally, and perhaps most cynically and probably most accurate, is it's year-end bonus season. So if you're an institutional manager of money and you're not quite keeping up with your peers, this is the time that they hit the gas to try to make up for lost ground so that they can earn a bigger year-end bonus. It sounds crazy, but I promise you it's true and it does happen. But here's the catch. It does not happen every year. In fact, even just recently in 2024 to 2025, the market actually lost value across all 3 major indices. The reality is, these short-term patterns really shouldn't have an impact on your investment strategy, but it's always good to know what on earth they're talking about when they're talking about the Santa Claus rally on financial media. To learn more about market behavior and behavioral finance, feel free to follow me.